But you know what? Today, it promises to be a decent opening for the market. So let's just wait for that. The pre-opening rates are suggesting a mild... Okay, that's a big start, actually, about 90-point start. The market, remember, last few days has been in consolidation mode, but with a positive bias. Yes, there's been a lot of intraday volatility, but by to a lot of those milestones, hit an all-time high and then cooled off quite a bit. So global cues are solid. Our own markets flows have thinned out a little bit, but lots of specific stocks in focus. IT is one space that will be in focus after Accenture's numbers and the guidance. They've narrowed their revenue guidance, but some brokerages believe that the results and the commentary pointed to a few positive data points like strategy and consulting returning to growth. So let's see how that space shapes up. Here's the first take on the index. The Sensex is up 100 points. The Nifty is up 35 points. So looking good. The Nifty holding on to 23,600 now. And, you know, the market breadth as well in favor of the advances. 1,400 stocks on the advancing side. The IT index is the one actually that's playing catch up now. 1.5% higher on the Nifty IT index, led by TCS, Infosys, Tech Mahindra, HCL Tech, Wipro. All these stocks trending in the green. You can see on your screen, a lot of the IT stocks are now, you know, on the top, followed by names like Maruti, Cipla, Bharti, NTPC, SBI Life, etc. What's not doing well is the banking names. I mean, not doing well, just flat with a bit of a negative bias. So names like SBI trending a tad bit in the red. A couple of these auto names like Hero MotoCorp, Tata Motors also a tad bit in the red right now. Nothing alarming there. Dr. Reddy's, Kotak, Reliance, ONGC are also a little bit in the red at the moment. But otherwise, it's not a bad opening. It's a decent opening, you'd have to say. The Nifty holding on to gains of around 50-odd points. And it's the IT index led by Accenture perhaps and the commentary. Morgan Stanley put out a positive note on Accenture as well. They say that some of these segments like strategy and consulting are returning to growth and there's a pickup in smaller deals. So perhaps the street likes that. And a lot of these IT stocks. I mean, it's interesting, right? Between banks and IT, something always performs, making sure that the market stays at these record highs.
Absolutely. I mean, today it's a little quiet for banks, but IT is really picking up that slack. Big moves. LTI. There's granules on the upside. Not too much moving right now. Some of the, by the way, the fertilizer stocks, some of them are still excited. CE Info Systems, it was a pick by Goldman yesterday, and it rallied, I think, 20% the stock yesterday. And now it's putting on another 7.5%. So big move coming in over there. What else? Time Techno, we just discussed the stock. It is up about 10% straight away. Some buying on Shakti pumps continuing from yesterday. So some interesting names. But I have to say that, you know, it's not exactly bursting off the charts. It's select in the mid-cap space and the Nifty trying to build on the gains now.
Not too bad, actually, because, you know, it appears like that of a relay race where one sector tires out or maybe runs its course and thereafter passes the baton to the other one. And that's exactly what's happening between bank and the IT space, keeping the Nifty afloat around 23,630. Remember, there's also the zone where the Nifty has seen a bit of supply for the last couple of trading sessions. So whether it sustains here or not is something that we'll have to keep an eye out on. The broader market's doing extremely well. We have nearly 4 stocks advancing for every stock which is declining. So on the NSE, 1,600 stocks in the green, 400 stocks in the red. Among the stocks in the green are the mid-cap IT stocks, and they're surging. Look at something like a Happiest Mind, which is up around 6%. First Source is up as well. Hormas did tell us about that. We're seeing traction in Persistent and Coforge along with L&T Tech and Emphasis too. The ones which are not doing particularly well, we have seen some profit taking in Chambal Fertilizers. Opened higher, and from there itself, it's corrected about 6% from the highs. Now it's exited F&O ban, and maybe the street is looking at booking some profits ahead of the GST meet event tomorrow in names which have run up. So RCF, for instance, is off highs of 5% from the highs, and we're seeing some the same you know, fate for something like a Fact as well, which is off about 5-6% from the highs after rallying about 30-40% in this week so far. Among the broader market stocks which are doing well, we have IIFL Securities right off the blocks up around 9%. So that stock's continuing to surge. And we're also seeing some traction in the real estate pack, which continues. So Purvankara, for instance, we have India Bulls Real Estate, second day running, seeing some traction. And in the snacking space in particular, we have Bikaji, which is higher. Edelweiss, rather, Nuvama has initiated coverage with a target price of almost 885 rupees on that counter. And looking at Bikaji, we have another snacking stock, which is Gopal Snacks, which is gaining traction as well. So both Bhujia and Gathia are doing well this Friday morning, if you were.
Getting very hungry, getting really hungry now, talking about bhujia, ghatia and all of that. Haven't even had breakfast here, but yeah, big moves coming in on so many of these names. By the way, big moves in IT. Just look at that. I think it's really the star of the show right now. TCS, I think, is up almost 2.5%. HCL Tech is up 2%. And, you know, we've been ad nauseum harping on the fact that IT has underperformed so much. At some point in time, it's going to come back into action. And lo and behold, Tech Mahindra is up 3% right now. So big moves coming into the IT names, especially perhaps after what Accenture said. There was no bad news this time around. There was no major negative commentary. If anything, the commentary has improved from Accenture's front. And I think just clinging on to those, straws are the IT companies, and big moves. Of course, it's also a valuation game, right? There's perhaps a valuation catch-up as well that some of these underperformers are doing at the moment.
Absolutely. So technology indeed is the spot. You picked anything else, Pankaj?
Just a word on Aster DM. The 9% equity which was supposed to change hands has happened. The block deal has happened. The stock actually opened much lower. The deal was done at a discount of about 4%, but the selling is done, has made the stock recover a fair bit from the lows, and now was virtually into the green, just about flattening out. So Vivek had told us that, once the supply gets absorbed, maybe we can see a bit of an up move, especially given the valuation discount that it trades to as compared to all the other hospital stocks.
Absolutely. So that's Aster DM, another big deal done out of the way. By the way, HPCL and BPCL, they are ex-bonus today, so watch out for both of those stocks as well, which is why the price could look a little different. That's corporate action that's playing out on both HP and BP, which is why you're seeing that big downtick on the price. Let's get some perspective then on this market with Pankaj Tibrewal, co-founder and CIO at KEI Asset Manager. Thanks very much, Pankaj. Always a pleasure to have you on our shows. So yeah, I think this market has defied all odds. It's been defying gravity. It's charging higher. But I think the question that most people are now grappling with, how do you put fresh money to work? Whatever's already invested, people are enjoying and, going ahead with the ride. But buying a fresh one wonders if you should wait for that dip, what to do, what not to do. And the dips rarely come. Your thoughts on how one should be approaching things from here on?
Good morning, Surbi. Yes, absolutely, you are right. Post the election day fall, we have seen markets make a very strong comeback and cross the all-time highs. However, at this stage, I think it's very important for all of us not to get carried away because mistakes are made at the top of the market. And we believe that there is froth in many pockets. We were just looking at some of the delivery data of some of the best performing stocks across the board. And it's startling to see that in many stocks, the last 6 months cash delivery volumes exceed the free float market cap. And this time, the entire rally is driven by non-institutional investors. And whichever pockets and institutional investors I speak to, global or local, I think everybody agrees to the fact that there are many pockets where you can't justify valuations. And it's basically moving because of non-institutional investors. And I think markets are at a big high. I think today we should take this opportunity to talk about looking into the history, what could be the risk at this stage in the market. And at this stage, I think it's very important for every investor to have a clear view on the risk in the portfolio, as well as in the stocks they are carrying. Otherwise, mistakes are made at the top. I think few things which you need to understand that today the contribution of mid and small caps as a percentage to overall market capitalization stands at about 36%. And their profit contribution is about 25%. So the divergence is clearly there between the profit as well as the market capitalization contribution. The second point we need to understand, Sophie, is that today the investors are expecting a very strong earnings growth. When we do a reverse DCF for a lot of companies, we believe that market is expecting unreasonable earnings CAGR for the next 15, 20 years, which looks difficult from our side. Third, when we look at and dissect the fourth quarter earnings, summary of NSE 500 companies. There are 87 companies which are banking and financial companies. There are 413 non-banking and financial companies. And the entire growth last quarter was carried away, was done by banking and financial services, which grew at 24%. And the non-banking and financial services, which is largely the larger part of India, grew just at 7.5–8%. So we believe that the earnings growth after a long time is starting to slow down. Last year, NSE 500 companies grew at 30% from a FY23 base. I think this number could be about 14–15% this year. So I think we need to take cognizance that earnings have started to slow down in the broader markets. And I think valuations are not factoring in that. Going into the history, there are four kinds of risks which generally comes through. The first is through macroeconomic instability, which we saw in the Asian crisis, which we saw in tapering tantrum. The second is the leverage part on the households, government, corporates. The third is the political and economic instability. And the fourth is the man-made or natural disasters, which we saw in COVID. The first three obviously are looking good for India. There's no problem. Fourth, nobody can call out. So I think risk today, nobody can foresee today. But from a valuation perspective, government policies, taxation, the murmurs which are going around on capital gains, I think something could disrupt, and valuations are something which we should not ignore at the current juncture today.
Okay, so we shouldn't ignore valuations at the current juncture. Got that. Pankaj, hi, good morning, and good to see you in after a while. We have a big event upon us, which is the union budget, right? Do you think there's anything in the budget that can be market moving? What is your ask from the finance minister this time around? Because considering that they've come back to power now for the third time in a row, I'm sure there's some aces up their sleeve. But from a market standpoint, what are you expecting?
Good morning, Sonia. I think just in a month's time, budget will be around the corner. Look at the data. In the last 4 to 5 years, the spend on rural has been absolutely flat, which is about 4 lakh crores. The direct expenditure of central government on rural schemes has been flat at about 4 lakh crores. Looking into the election verdict which came, and we analyzed the data very carefully, the government lost about 60 seats in the rural areas. And that's a large number. Our sense is that probably a part of that expenditure, which has been flat for the last 4–5 years, will see an uptick. And on the same breath, the capex expenditure, which was at about 3–3.5 lakh crores, is expected to be 11 lakh crores. So I'm not saying that the capex expenditure would see a dip, but it could see a moderation. And a part of that capex expenditure could be shifted to rural. And I think on that side, consumption could see a comeback. Our channel checks across last 1 to 2 months have been suggesting that there's an uptick in the rural consumption space already. And though companies are not very confident whether it will be sustainable, but our channel checks across the board is suggesting there has been an uptick on the rural side. And I think that's going to continue. Also, we believe that the consumer durable space probably can make a comeback. We have seen very strong summer, and that's likely to sustain going forward as well.
Okay, so you're positive on both rural names as well as urban discretionary consumer durables names as well. You did allude to valuations being stretched in a lot of parts of the market. What are your thoughts on relative valuations in the consumer space right now? Is there a lot of upside? How do you play this? Do you play this via the staples, or do you play it by some new age themes? How do you go about this?
So obviously valuations on a relative basis, are looking not so great across the sectors, except banking, maybe pharma, maybe some of the consumer rural discretionary names, and so on and so forth. But one thing which is a very interesting data point, over the last decade, the consumption in India has gone through a massive change. The composition of consumption today, which includes smartphones, wearables, OTT, mobile data, is now about 6.5 lakh crores spent, which was not there a decade back. So when we talk about consumption, we also need to take into account these categories which were non-existent, a decade back. And mind you, this is not a small number. It's twice the size of the car market in India and 6 times the size of the two-wheeler market in India. And hence, we need to see consumption on a holistic basis. I believe that there has been a rise, and there will be some shift from these categories to the main staples and some of the urban discretionary names, especially the consumer discretionary names. We believe that the non-linearity in margins could be very high. For example, in consumer durables, the profit pool is at a decadal low. And I think that will limit competition going forward. And many players, we would see non-linearity in margins. Margins are at rock bottom today. And once top line starts growing, margins will automatically see a comeback.
Okay, I wanted to come back to the first point that you were making about how you're a bit bearish on the market. You think earnings could slow down a bit. So how are you positioning yourself? Which are the sectors that you would be avoiding now because of steep valuations? And which are the sectors that you like? I mean, you spoke about how consumer durables may make a comeback, but overall, how are you positioning yourself?
So, Sonia, I think there are 3-4 sectors where we believe that there's a lot of margin of safety. The first one is private sector financials. We believe that they have been continuously growing, delivering good numbers. And there is reasonable margin of safety when we look at their franchise and when we look at the growth potential ahead. The second is pharma. I believe that pharma, both from domestic and US generic side, is offering decent margin of safety in terms of valuation, and on a PEG basis, which is for the growth per unit of growth, what price you are paying, seems to be reasonable. The third is the entire consumer pack. I think we need to be careful on that side in terms of many names still at punchy valuations, but there seems to be growth returning back into that sector. And that's where incremental, opportunity lies. And last but not the least, I think some of the industrial names which are linked to private capex. Having said that, what to avoid? I think clearly the list is loud and clear. Some names where there's low free float, names where there's business to government businesses, but factoring in huge expectations and small change in policy can derail them in terms of overall growth trajectory. And making sure that we understand what we are paying for the next 10, 15 years from a stock in terms of valuation. So the no-go list is very, very clear, and we need to avoid them and make sure that over the next 12 to 18 months, we navigate this market carefully. I think the important point today is not to focus too much on upside immediately. I think the focus should be preservation of capital over the next 12 to 18 months as we move ahead.
All right, preservation of capital over the next 12 to 18 months by being in places that offer margin of safety. Pankaj, in light of all of this, there are always some new themes that are playing out in the market. Is there anything that you found which you think is interesting and this is a theme that could maybe generate some alpha over the near future?
Absolutely. The consumption basket, which has been new completely, the 6.5 lakh crores, which includes so many other new categories, probably will see itself getting listed over the next few years. And I think that will be an interesting space because consumer preferences have been changing in terms of spend. And any company riding that will be an important portion. Second is the most important is the premiumization, which has been growing in India. And I think companies offering on that side may come for listing over the next 18, 24 months. And I think what is interesting in this market is that good quality companies are getting listed with good business models. And I think that will increase the market breadth as you move forward. And the third is on the tech side. Many of the companies are non-listed today, and some have got very strong business models. We are eagerly waiting for some of them to get listed as you move ahead.
We have the Stanley IPO listing today. I don't know what you think of it. Then there's Hyundai, some of the bigger ones that we are talking about. There's Ola Electric, a lot of the others. Could you name some of the IPOs that you are eyeing this in the next 12 to 18 months?
I won't go stock specific, but generally this will be the focus where we would deploy incremental capital on the new listing. Also, I think that there are many names in the listed space also, which are offering decent opportunity if you take a 5-year, 10-year view on them, especially on the premiumization theme.
Okay, Pankaj, thanks a lot for joining in and have a great day, have a good weekend. Well, that's the word coming in on the markets, which, by the way, are holding okay. I mean, holding well, actually. The Nifty is up almost 70 points. It's picked up in the last 10-15 minutes, and it is pretty strong. I mean, look at the moves in the IT space, and you'll notice that's really the space to be right now. Let's slip into a quick break. On the other side, we'll connect with Anil Gupta, the chairman and MD at KEI Industries, to talk about the workers' strike at two of their plants and their business outlook. Stay tuned. Well, as promised, we have the management of KEI Industries now with us. The company announced that its plants at Rakholi and Chinchpada were partially affected because of a production stoppage, because of a labour strike. To talk more on this issue, Anil Gupta, the chairman and MD at KEI Industries, joins us now to talk about that. Mr. Gupta, thanks for joining in. Can you tell us how is the situation right now as far as the labour strike is concerned? When will the situation normalize? And is there any kind of financial impact that you've seen on business because of this?
Good morning for inviting me to the show. The partial strike, which has been affected to two of our plants, is now withdrawn. It is our production is fully restored since yesterday evening, and actually the production started since yesterday afternoon itself, and everything went normal, and it is normal. We have already communicated to the stock exchanges about the normalcy of the production and restoration of the production. And it has a very little impact. Close to around 10 crore worth of production is lost in 1 day and a few 3-4 hours, and we'll make it up.
All right, so just about 10 crore worth production lost because of this strike, so not much in your overall scheme of things. In any case, if you could, reiterate your guidance for this year for the viewers, what kind of volumes are you gunning for? Is there any price hike that you're looking at in the cables and wires business? At the same time, the first quarter, how was that for you? And how is that in line with your guidance that you've given for the full year?
The first quarter, is it in line with whatever guidance we have given in the beginning of this year? And I think everything is going normal. The demand is strong. We have a very strong order book position from domestic markets as well as export markets. And I think that demand traction will continue considering the capex push and investments coming in the industrial projects, real estate, etc. Similarly, very strong demand from our export customers as well, our export markets.
Okay, that's interesting. So, can you tell us this B2C business, you are aiming to increase the B2C business share to 50%. Currently, it's about 45-46%. What is the kind of growth that you've seen there? What's the kind of demand? You just spoke about how real estate, etc., is picking up in a big way. But tell us, what would the contribution be, not just in the next 1 year, but over the next couple of years from B2C? And will that lead to better margins?
See, we aim to, reach to 50% level by end of this financial year. In fact, since all our export business is, growing, and that we classify into B2B. So, and B2C we classify only for our domestic business. So, in fact, the domestic business through B2C should exceed 50% by end of this financial year, according to our estimation. And as far as margins are concerned, I think we have already given a guidance of close to 11%. We will try to improve upon that, but I don't want to, change the guidance.
All right. You, for the top line, had given around 15 to 16% guidance for the year. You believe that that is also, likely to be unchanged for the now?
Yes.
All right. What about, your EPC business? You said that you are looking to bid in projects worth about 500 crores, or you haven't bid much. You've looked at constraining that business to just about 500 crores. Can you tell us why exactly is that, and what's the outlook for this business going forward?
You see, this business can be grown to any size because, there are ample opportunities and ample tenders in this space. We can try to improve it by a few, 10-20%, but we don't want to ramp it too much because of the, normally the cash flow issues in this EPC business from the utilities. So that is the main reason that we contained it and we are trying to limit it to this level.
And what about exports? What are they as a proportion of your sales? You are gunning for what, 50% growth this year in exports?
Yeah, so I expect that we should get around 15% of our total sales from exports this year, which means that we have to grow by 50% in exports this year.
Okay, you're also expecting a overall 50% growth in exports in FY25, is it?
Yes, exactly.
Okay, that's interesting. And what about your working capital cycle? Where are we at right now? And is there scope to improve the working capital cycle?
It is continuously improving for last many years. And every year we are reducing the working capital days by approximately 8 to 10 days. The reason is, one is growing exports, growing B2C business where we get the money through channel finance from the dealers, and also reducing the EPC business. All these measures has been taken to improve the cash flows. And I think if we are able to maintain around 2 months of the working capital cycle in the overall business, we will remain a debt-free company.
Right. Since you're looking to increase your B2C, exposure and your presence out there, just wanted to understand who exactly would be your competitors, what would differentiate your propositions from them, and once competition increases in the B2C space with you coming in, could there be any impact on margins? What's your strategy here?
I mean, normally our competitors in B2C space is Havells, Polycab, and Finolex. But ultimately they are also operating in the similar range of margins. So, nobody would like to reduce their margins by, just increasing the top line. So we are operating at a very reasonable level of EBITDA. So with the very high level of production efficiency and production economics, I think we will be able to improve our margins year after year in spite of having competition.
Do you have market share targets here? What does it currently stand at, and what do you aspire for it to go to?
Our market share in cables should be around, and I don't have the firm data, but maybe around 12%, and in the houseware business around 6%. So overall market share may be around 10%.
Okay, overall market share around 10%. Got it. Mr. Gupta, thanks a lot for joining in and speaking to us on CNBC TV18. That's KEI Industries talking about the issues that they were facing at their plant, but also the way forward for the business. They say that there is a big capex push that they're looking at, and demand traction will continue on the back of that. The stock is actually doing pretty well. In the last 1 month, it's gained about 10%. Today, the stock is up 2.5%, and the B2C business is picking up in a big way because of very good traction coming in for wires and cables, especially in spaces like real estate and infrastructure. So that's KEI Industries. Been a big play over the last many weeks and months. And I think if you pull up a 1-year chart, you'll see there's been significant growth over there. But overall for the markets, yeah.
I was just saying that the markets have actually slipped, and the slip has been led largely by the Nifty Bank. The Nifty Bank is down about 250 odd points right now, 0.5%, and as a result of which the Sensex has slipped into the red, and the Nifty just about holding in the green by the skin of its teeth. We have HDFC Bank, which is the top contributor on downside for the frontline index. Also not giving it any support are the FMCG stocks. So HUL at the low point of trade, Asian Paints not doing too well. Some other consumption names as well, like Maruti down, from the early levels, the opening levels. And we have the list of draggers as well as, contributors on the way up for the Nifty, up for you. Maruti Suzuki was open in the green, now has moved into the red. And we're seeing some of this decline play out in a couple of other names as well in the mid-cap end of things. So we have something like Chambal Fertilizers, which is down about 8-9% from the highs, down 6% now. GNFC down 5%. Delta Corp had seen a big rally over the last few trading sessions, down about 3% ahead of the GST meet event tomorrow. City Union Bank, Coromandel and Tata Chemical. So a bunch of stocks actually now coming off the highs of this morning and moving towards the low point of today's trading session.
Okay, well, a lot of individual stocks. By the way, Kotak Mahindra Bank is now below the 200-day moving average. So there is some, technical levels that we're looking at over there. Time Technoplast continues to be on the in focus, so keep an eye out on that. And a couple of other names. Lupin is in focus as well. Antique has put out a note where they've maintained a buy. They have a target price of 1958 on the stock. They remain quite optimistic on the US generic opportunities with limited competition launches. So Lupin up almost about 0.6%. But let's talk about the Accenture numbers as well as the way forward for the IT companies. Kumar Rakesh, the India analyst at BNP Paribas, joins in. We also have Abhishek Kumar, the equity research analyst at JM Financial. Gentlemen, morning to both of you, and thank you for joining us on the show. Kumar Rakesh, I want to start with you first. Your thoughts on Accenture's numbers and what would the read-through be for companies in the IT sector back home?
Hi, good morning, Sonia. Thank you for inviting me on the show. So last quarter, when the company had reported their results, that actually started the underperformance of the entire Indian IT services sector. And that time, the concern had started that possibly the IT services demand is going to take longer to recover, given the guidance cut by the global peer. And since then, as we have seen, most of the Indian IT services companies underperforming. Last night, with the results which they have reported and the commentary, it appears that possibly the demand bottoming out has already happened and some recovery is already visible in the numbers which are reported. And that should ease investors' concern that possibly the worst is behind and we should start looking at the recovery in the coming quarters. For Indian IT services companies, as we have been noting, that the cyclical bottoming out likely happened in the December quarter itself. March quarter numbers, if you would see, for most of the companies on a YOY basis, they had started seeing improvement on the growth. Even if it was a decline, it was a lower decline. And hence the cyclical recovery already got underway. Obviously, a larger global peer, if they continue to see a weakness, it was not really getting appreciated here for Indian IT services companies. But as we move into the coming quarters and exit FY25, we would expect that this YOY improvement in the revenue growth should continue to play out. And given how investors are highly bearishly positioned for the sector, this implies that there should be a reasonable upside in the sector.
All right, reasonable upside. We'll come back to you, Kumar. Let's talk to Abhishek Kumar, who's the equity research analyst at JM Financial as well. Abhishek, what are the overlaps from Accenture into Indian IT? What sectors are, direct correlations out there? And in that, how was the performance? How would you read that for the Indian stocks?
Yeah, hi, good morning. Thanks for having me here. In terms of overlap, look, Accenture is a very large company, probably works in all the verticals where Indian IT is present. Specifically calling out a couple of segments. One, I think if we look at their managed services bookings, that was up 42% on a YOY basis. Even if we look at the trailing 12-month, the book to bill in managed services, which is more similar to what Indian IT does, was up to 1.3x, which is highest since pandemic. So there are signs that those large deals, etc., that momentum continues. The pipeline also is good. Second, one sector which was particularly stressed was communication. That has been declining for past 7 quarters sequentially for Accenture as well. This quarter, it moved up. It showed 4% sequential growth, which, again, gives us some signs that there's some bottom formation happening. So that's a large sector for Tech Mahindra, and therefore we can just have some positive read through for Tech Mahindra from communications vertical performance.
Okay, positive read-through for Tech Mahindra. Any other stocks that you would be bullish on where valuations still look attractive and there is some growth potential as well, Abhishek?
Yeah, so we like Infosys and Wipro. Consulting coming back to growth next quarter as per Accenture after 5 quarters of decline, kind of validates the view that Wipro had, where they were seeing green shoots in their consulting business. So that kind of validates that view. So positive for Wipro. And Infosys generally, given where their guidance is and where the expectations are, I think there's very limited downside as far as the earnings are concerned. So we are positive on these 3 stocks.
Got it. All right. So Infosys and Wipro is what you like. I also wanted to go back to Kumar. Rakesh Kumar, your thoughts on what are the stocks where there could be still some earnings upside as well as a valuation, legroom now?
So Sonia, if you look at the broader sector, first of all, I think the entire sector is heavily underweight across both foreign institutional holders as well as domestic holders. Their portfolio allocation to IT sector is now close to about 8.5%, 8.2% of their overall portfolio, which is significant underweight. And this level of bearishness last time we had seen was in 2016-17. So there is a significant underweight position, which we expect should start normalizing and should start moving towards equal weight. And that itself should drive positivity and positive stock reaction across all the sectors. And the first leg would be reflecting in the valuation expansion. So that is the first thing which we would expect, that across most of the companies who are going to either even meeting expectations would be good enough in the coming quarters with neutral to positive margin commentary. And that should result into the kind of stock reaction which we are seeing today. So the first leg should be driven by significant underweight position moving closer to the equal weight position, driving the valuation of the sector. The second leg will start coming up from the earnings upgrade potential. And if you look at the consensus expectation, what consensus is building this financial year's exit YOY revenue growth and the next year's YOY revenue growth, both of them are largely similar actually. So what it is implying that the consensus numbers are not building any further recovery in revenue growth going into FY26. And that is something which can potentially start seeing an upgrade across the companies where the expectations already are sitting pretty low. And hence that creates the second leg of drive into the earnings upgrade potential. And that is where Infosys definitely stands out, where the expectations already are quite beaten down and hence much higher possibility of earnings upgrade as well happening. And hence Infosys also is our top pick.
All right, Infosys is a top pick across BNP Paribas and JM Financial. Finally, let's wrap it up, Abhishek, with the mid-cap end of things. What are your top picks in mid-cap IT, if at all you track them?
So I'll not be able to talk about mid-cap in this call, but generally we prefer large caps over mid-caps, given, as Rakesh was also mentioning, the positioning of the investors. And also, I think, they have the large caps have already taken a brunt of hit on their margins, given the large deals coming in. And as these deals get into the maturity phase and discretionary comes back, come FY26, there is a margin expansion possible in large cap. So we would stick to large cap at this stage.
All right. Thanks a lot, gentlemen, for joining in and putting focus on the IT space right now. That definitely is, helping the market stay afloat in the Nifty in the green right now post Accenture's numbers. And you say risk reward in favor of the IT stocks. Potential re-rating may be likely if things improve from here on, given the underperformance. In the market, a couple of themes are doing well this morning. We have the telecom space, which is now a buzz. So Bharti Airtel has moved to the high point of trade. We're seeing some traction in Vodafone Idea as well, opened in the red and now has moved to the high point of trade once again. And that's because maybe now the street hopes, with the telecom data out of the way, with all the elections related issues out of the way, there could be a round of price hikes. So that's the forever hope right now for the last couple of months for the telecom space. And now with all these triggers away, let's see whether that actually pans out or not. And in the broader markets, we have Raymond, which is up 10%. Railtel, which is up another 8% today. Cera Sanitary, we're up 6.5%. So there are specific stocks which continue to do well. And in that, Gravita also is one of them, which is up around 12%. Remember, the management joined us here on CNBC-TV18 a couple of days ago, saying that some of their new geographies would do well for them in terms of growth, and the lithium-ion vertical will also aid growth. So that's about Gravita. But let's talk about CAMS. CAMS Insurance Repository Services has launched Bima Central for insurance portfolio management. To discuss more on this and the growth outlook, we have Anuj Kumar, who's the MD of CAMS, joining us. Thanks a lot, Mr. Anuj Kumar, for joining in. Always a pleasure speaking with you. Let's talk about this, e-insurance platform itself. With the IRDAI's push on e-insurance, what do you think is the growth potential? What are the number of customers that you plan to onboard on this? And I believe you were looking at break-even in this quarter itself. Will that happen?
Hi, good morning. Thanks for having me over on the show. So overall on e-insurance, I think when you look at the market broadly, the outlook is bullish. Of the total insurance policies available in the country, under 5% are under e-insurance right now because it is effectively not mandatory yet. It's more an individual consumer choice. As we launch platforms and as the overall the push from regulatory and market perspective increases on this, you can expect that this 5% penetration will continue to grow. So this market could scale several times. And we've been holding share in the range of about 35% in the market. So we're very bullish on this construct. And we believe that this market is set to expand.
You believe that the market is set to expand. So can you help us with some numbers when you talk about the expansion? I mean, what is the kind of growth that you're looking at? I mean, what are the customers that you're expecting to onboard? Because IRDAI has been pushing on e-insurance quite a bit. So, overall, what can we expect over the next 1 to 2 years?
So broadly, when this was launched several years back, it was expected that e-insurance holding would become mandatory. It is not in that state yet. The recent announcement means that insurance policies could be held in the insurance account, could also be held in DigiLocker, or could be held in a PDF format. So it is yet not mandatory. But from a market perspective, from about a mass of 55 crore plus policies, just about 3 crore are held in the DMAT form. So that's about 5%, a 20x compounding of this entire construct can happen if ever this goes into mandatory DMAT, for which there is no announcement right now. However, individual consumers are preferring to hold their policies in the e-insurance format. So you can expect a high double-digit growth going here forwards. Also, in terms of being able to manage your data at a single level, at an e-insurance policy level, to do potentially digital lien marking, which will happen over a period of time. You could, monitor your maturity values in a single screen view. You could pay insurance premiums, lodge your claims. There are a lot of things possible in the e-insurance construct. It's very insurer-friendly, so to say. And as we've launched Bima Central, of course, we'll have to integrate all the 50 insurers. Today, there are just a few which have got fully integrated, but that process continues. And we believe this is the kind of benefit that has not been offered in the marketplace. It's a very unique platform right now. We're already beginning to see offtake in terms of transactions building up. So we are very bullish on this.
Yeah, but if you could put numbers on their bullishness, what do you think is the TAM for this? Since you said only 5% right now are e-insurance, there is a 95% upside in terms of market moving forward. What are the kind of customer numbers that you expect to onboard? And at what level does Bima Central start contributing meaningfully to your earnings?
Bima Central will contribute to earnings maybe in 3 or 4 years. Today, we're just spending money promoting it and making sure that consumers get a unique digital experience from that. So from a financial perspective, it will take several years for it to break even and start making money. At the base level, today, think of it as about 7.5 million policies, 75 lakh policies being held by us in the DMAT format. We're expecting that to grow by over 25 lakhs, so almost about a 35% growth this year. Also remember that in the base, a lot of consumers may not be converting their policies. There's a lot of new sale which is coming into this. That trend will continue for base policies to get converted. I think it just needs a strong nudge either from the industry or the regulatory side. On the new sales, which is between 2 to 3 crore policies every year, you will see that a lot of those will get sold in, under the insurance format.
Okay, got it. The non-MF business is also picking up traction. What is the kind of growth that you're looking at there, and what's the headroom in terms of margin improvement?
So last year we grew non-MF by 52%. If I counted on a constant base, which is without the Think Analytics portion, we grew about 38%. We are hoping to grow non-MF close to 30% this year. We're seeing all the tailwinds. Our KRA business had grown 90% last year. We're expecting that to scale beyond 30%. Our accent to sell to depository participants and brokerages has succeeded. We were a pure mutual funds player and we've broadened out, so that's a good play happening. Our payments business grew 26% last year. We're expecting that to grow about 30% this year. So strong tailwinds in both of them. And on account aggregator, we continue to put out newer formats of consumption, both on the wealth management, which is the personal finance management side, also on the digital lending, flow-based lending side. So those consumption patterns are quite evident in the marketplace. Our daily consumption of bank and other statements has crossed a lakh daily, which is a significant milestone, and we're expecting it to scale at least 2 to 3x within this year. So non-MF broadly this year should grow in the vicinity of about 30%. From a profitability perspective, we've been investing in the platforms for the last 3 years. Some of them will return to break even this year. So overall, our target is that at company level, we should drive non-MF to a 30% EBITDA line. That should happen over the next 4 to 6 quarters.
What about, since we're speaking about the insurance space itself, I remember you last time said that you are scanning the market for inorganic opportunities, mainly in the insurance and payment space. How far have discussions moved? Are there any at the advanced stages, something that we can hear in the near future?
I think you should hear something this year. I will not time it accurately, but you should hear something this year. I think there are very exciting opportunities in both the spaces. And with our accent on building non-MF and scaling it to 20% revenue contribution, we believe that the next step is to onboard a strong franchise from the market. So you'll hear something this year in terms of our next moves.
Just before we let you go, just roughly, because you have about 600 crores of cash on your books.
Yeah, so I don't think we're going to make a big bang acquisition. It will not be a big bang acquisition where I have to go and borrow monies, etc. We will just fund what we have on the books to buy this. So it could be, in the range of, I would say, a few hundred crore in terms of capital outlay. And we will talk more about this as we get closer to the event.
Okay, thanks a lot for that, Mr. Kumar. Pleasure having you on the channel here. That scam's up almost 2.5% right now. But let's get back to the market. If we can get the Nifty chart up on the screen, you'll see that it's pretty decent in terms of the morning move. Just that it's come off a little bit, but still holding with gains of 50 points. Mitesh Thakkar is back with us. Mitesh, what are the stocks that you're looking at this hour? And do you expect some volatility to kick in for the rest of the day?
I think, the Nifty is doing pretty okay. And, we've made another high by getting past 23,600 on the spot. And the overall breadth is good. But what is in focus is the Nifty IT. I think very strong continuation pattern being seen over there. And that is the index which is propelling the Nifty. So I think maybe from a trading point of view, you should look at Nifty IT. And on the Nifty, as I said, I think keep trailing your stop losses. The latest level would be around 23,445 on the spot, which is about 180 points lower.
So what would be the pick here in terms of stocks, Mitesh?
So, Mangalam, as I said, I think it should be the IT pack. So I have a buy on Wipro. Wipro, I think, hasn't moved as much, so it could see some catch up, and therefore recommending a buy with a stop at about 489 for targets of 510. And Infi is showing good traction after opening gap up, so Infi can be bought with a stop at about 1529 for targets of 1580.
Okay, thanks for that. Let's slip into a quick break. On the other side, we'll put focus on the commodity space with Manisha Gupta. Stay tuned.
I'm joined in by three individuals who have inspired all of us. Usha Soman, her son Milind Soman, his wife Ankita Kuwar.
When you're talking about fitness, is mobility. If you can't move, how will you get fit? If your mind doesn't move, how does it get fit? If your body doesn't move, how does it get fit? So mobility is the most important thing.
Oh, why do I have some fat around here? That's maybe because the body needs it. Why do I like this certain kind of food? Maybe because my body wants that. So just accept yourself for who you are, what you are. At this moment, this is the best version of yourself that you'll ever be.
Ai, what is next goal challenge that you've set up for yourself?
One thing in my bucket list is bungee jumping.
Bungee jumping. Oh my God.
And skydiving.
And skydiving.
Shifting focus to the commodity markets, Manisha Gupta joins in. Manisha, what's the one commodity you're tracking today?
Thank you for that, Sonia. Well, I'm looking at metals, precious and industrial, and there is a lot of buying in both of these sectors there. So weaker than economic US data is what has led to a decline in US dollar and expectation that you could be looking at a Fed rate cut going forward in the month of September. The possibility of that is now 67%, and that has led some buying coming in for many of these metals there. Also, it has to do with the geopolitical concerns because, you know, when it comes to metals, when it comes to precious metals especially, we are hearing more news and reports coming in from the Red Sea now. What we do understand that until now there have been more than 70 attacks there. One vessel has been seized, 2 ships sunk. The second one was sunk yesterday. So that is what has led to some geopolitical premium also coming in for the prices there. And then, as I said, a couple of central banks already have cut rates, and the markets do anticipate that the Swiss National Bank, and you could be getting it coming in from China and the US Fed in the month of September. So by the third quarter, there could be more banks joining the bandwagon when it comes to rate cuts, and that clearly has been supportive. In any case, the metals have been consolidating for the last couple of weeks, and we've seen buying opportunities come in on the lower side. So within the precious metals, silver prices gained 3.5%, gold was up 1%, and both the precious metals are now trading at a 2-week highs into the markets. Copper prices also gained up by more than a percentage point, and we are looking at prices inching closer to $10,000 a ton mark. The low in this week itself has been $9,550. So we're looking at considerable gain from its lows, and that has been supportive. I also want to talk about zinc because that has been a bit of an underperformer, but we've seen stronger gains come in for this one as well, and that is because the surplus that the zinc has been carrying for the last couple of years now seems to be going down. So if you look at those numbers there, we've seen prices gain up by 3.5% in this week itself. And that is because the surplus that the markets did see earlier have been continuing to decline. So last year, between Jan to March, the surplus that zinc had was 282,000 tons. This year, at the same period, it fell to almost half at 182,000. In the month of March, we were carrying a surplus of 70,000. Now it has fallen down to 22,000. So a very sharp decline, as you can see, over the past months that the zinc surplus has come down, and that clearly seems to be very supportive.
All right, Manisha, thanks a lot for that. So that's the commodities arena. But let's talk about First Source Solutions. We've been speaking about the IT pack. Hormaz told us earlier why First Source Solutions would be in focus, and now that the stock's moving, let's recap that. Hormaz.
All of IT has been buzzing because of Accenture's results, but First Source on its own had an analyst day and they've shared some targets for the near to medium term. Now, Nomura is saying that they have made significant progress on their One First Source strategy, and they are now aspiring for $1 billion revenue run rate by the fourth quarter of FY26 and to have an EBIT margin of 15% in the medium term. So these are the targets that First Source has laid out. And while they have no stated dividend policy, but they have been paying out close to 45 to 50% of their profits as dividend back to shareholders. Now, the senior leadership of the company has both time and performance-based stock incentives, according to Nomura. And what they also believe is that the net debt that First Source has, which is close to 600 crores in FY24, that is largely for working capital requirements. They also laid out some M&A strategies where they did not say whether there is an acquisition or a merger in the pipeline, but they mentioned that if they do something like this, it would focus on capability building and not on revenue accretion. So as a result of which, Nomura remains neutral on First Source Solutions with a price target of 200 rupees. The 10 analysts have coverage on First Source. 8 of them have a buy recommendation, 2 have a hold rating as well. So all in all, the entire IT space is buzzing, and First Source is no stranger to that as well.
Okay, thanks a lot for that. Well, Upasna is tracking time, Technoplast. Upasna, over to you.
Thanks so much for that. Well, Time Technoplast will remain in focus as the company has received final approval from Petroleum and Explosive Safety Organization. This approval is mainly for the manufacturing and supply of high-pressure composite cylinders for hydrogen. It is the first Indian company to receive this approval, and it believes that the move is in line with company's efforts towards sustainable green energy. With this approval, company says it is poised to capitalize on rapidly growing market driven by global shift towards sustainable green energy. It believes that this technology will certainly have a positive impact on both, that is industry, as well as on the environment.
All right, Upasna, thanks a lot for that. With that, what we'll do is take a short break with the news that the Nifty is holding mildly in the green. The Nifty banged down by about 0.5%. The mid-caps outperforming 1,400 stocks in the green for about 862 in the red. So the advanced decline chart comes up for you. We've seen some narrowing of the band, but still a fair distance between both the green and the red lines. So what we do is take a short break. On the other side, we have the India Economics segment where Lata joins in with a lot of power sector experts to discuss about power shortage and how policy and investors must look at this space. Stay tuned.
and welcome to a hot steaming Indianomics. I say that because 2023 is, I believe, the hottest year in India's history, and 2024 threatens to be worse. Today we discuss what this means for India's power sector. Should we expect power generating companies to become more profitable? And what else becomes more profitable? Should one invest more in, say, power equipment companies, power contractors, capital goods makers? And also, what about the downside? Can we expect intermittent power outages that mar production and productivity across the economy before capacity catches up? Joining me to discuss all these are Mohit Bhargava, the former Executive Director, NTPC Renewables and former CEO of NTPC Green Energy, Girish Kumar Kadam, the Senior VP and Group Head of Corporate Ratings at ICRA, and Nikhil Nigania, Director and Senior Analyst at Bernstein. Gentlemen, thank you very much. This is a power-packed panel in more ways than one. Mr. Bhargava, if I may start with you, the Indian Express just reported that power utility heads in Punjab and even in central utilities have warned that there is a chance of a grid collapse because peak demand is absolutely racing up. I mean, 89 gigawatts or something at one particular hour. Do you think we are in danger of power outages?
First and foremost, good afternoon and thanks for having me here. No, I'll not be that scary in my outlook because over the past 1 year, NTPC included and the government as a whole have been quite focused on ensuring that there is enough capacity. While I agree totally that, if I remember correctly, on the 30th of May,
yes.
India had recorded the highest demand of 250 gigawatts. And over the whole of June, we have been looking at about 233, 235 kind of gigawatt kind of demand. But we have been able to meet that. The challenge is not in not having capacity. That capacity is there. And thankfully, this time, even the thermal plants are quite comfortable on the coal sides. And we have had a lot of solar coming online. So from that angle, we are in a decent position to meet the demand. But yes, as the demand keeps increasing, if you look at last year, the demand growth was over 7-8%. Same looks the case this year also. And with the economy growth projected at 7% for this year and maybe at the same levels in the years going forward. So power capacity has to keep on catching up and ensuring that there's enough demand.
Okay. Nikhil, you have a note on how the power intensity of GDP is actually set to rise. So do you see more shortages before capacity catches up?
Sure, Lata. So our view, one is the demand side, second on the supply side. So power demand, actually, not just India, globally, it's been surprising on the upside. Reason for that, weather. So as you said, India, very warm weather we are seeing the last couple of years. And as per government, the global forecast, World Meteorological Organization forecast, likely to be warm for the next 5 years as well. Second driver of power demand then is new use cases of power. In India, not so much right now, but incrementally going forward through data centers, EVs, and possibly hydrogen in the future. So those are the stuff which are driving power demand faster than many anticipated globally. Now, coming to the supply side of things, the challenge we see is not per se the afternoon times of the day, the challenge we see the evening time of the day, where we feel government has thrown everything possible at the problem in the month of May, which was election month. And still we were just neck to neck. I mean, the peak demand afternoon was 250, evening was 236, and we barely met it. And if it keeps going at 6-7% per annum, the planned thermal addition of 8 gigawatts a year might not suffice unless battery and pump storage really picks up.
Okay.
So combination of these two things, evening shortage and strong.
So Nikhil, which part of the power universe is best placed to take advantage of an imminent, seller's market?
For sure. So if you look at the power value chain, we break it into three buckets. We break it into the utility companies, where we continue to like NTPC Power Grid as key beneficiaries with higher than expected capex, leading to strong profit growth over a long duration. The second bucket, which gains where at least we see strong institutional investor interest, is the capital good names. Because a strong capex, especially on pockets like transmission and distribution, is likely to lead to good order book and margin expansion for transmission equipment suppliers. The third pocket are the lenders, where you have power-specific NBFCs in India. And the same thing then trickles down, right? I mean, if you're going to do so much capex, then you need a good amount of debt funding for them as well. And even the bad debts which are there are likely to be reversed. If the demand-supply situation is tight, the thermal assets could get sold.
The unfortunate part in India
so all
is
three pockets gain per se are coverage.
Okay, I get that. Thanks for that. But just power financiers, a word more on that, Girish. Since you look at debt and that's of more imminent interest to you, do you foresee once again people reneging on bills? Even now, the DISCOM outstandings are not falling. They have been on the rise. Do you foresee that? I mean, the demand may be there, but it is not backed by the ability or at least the inclination to pay.
Yeah, so Lata, in fact, thanks to this late payment surcharge scheme, which was notified 18 months back, we have seen very encouraging trends so far. As far as the correction of the overdues are concerned, they are getting paid out, to the, Gencos, more or less in a timely manner through EMI route, thanks to debt funding availability from PFC, REC to the, the DISCOMs, whoever has participated in the LPS scheme. And again, as far as the regular bills are concerned, the DISCOMs are more or less paying in a timely manner, within 70 to 75 days. In few instances, with some more higher days, but it's broadly more or less in a timely manner, thanks to the provisions of the LPS scheme, which are pretty stringent. Because if the DISCOMs do not honor in a timely manner, there is going to be a curtailment in the open access scenario for availing the power through short-term, medium-term, and long-term, route. So that is working out. But fundamentally speaking, many of these state-owned DISCOMs, they continue to, have, structural issues in terms of higher cost overheads, still inadequate tariffs. The tariff hikes are pretty modest. In fact, less than 1 or 2%, consistently seen over the last 2 years. And while the subsidy flows have certainly improved, but the fundamental issues in terms of the higher AT&C loss levels and the higher operational cost overheads, and the fact that the debt burden is now higher because of the LPS scheme implementation. So these issues continue to persist, for the state-owned DISCOMs. So we see that the cash gap number for the DISCOMs to still remain elevated, again, because of, the higher dependency on the short-term power, because short-term power mix has also gone up. Almost 15% of the generation is now through short-term power route, which is a bit costly, almost 5 to 5.5 rupees a unit. And on top of that, the coal import dependency is also relatively in the range of 7 to 7.5%. So, which is why the fundamental issues, they require a significant correction for the DISCOMs going ahead.
Yes, we were running your cash gap. The difference between the cost and what is recovered by as revenue is still 45 paise per unit. I mean, that's something that should be alarming and can accumulate and hit at some point. Time permitting, I'll come back to the financing aspect. I'm missing a policymaker here, but Mr. Bhargava, you'll have to fill in that position. There was talk that IEX rates are actually at, 5 rupees 30 paise, 5 rupees 29 for quite some time. And there was talk that maybe Grid India should take over the demand supply and, marketing of short-term power requirements. Is there any such policy being mooted?
Honestly, I wouldn't be able to comment on that, Ms. Venkatesh. But the fact is that IEX and the short-term power market is definitely doing well. There's of course also talk of market coupling and all that. So the idea is that while the DISCOMs do not actually want to get into a long-term liability, and you might also see that through a lot of bids coming for short-term power procurement, say few months or 12 months or a couple of years, not like 25 years. But there's also a very high demand, and which is what NTPC has also seen, that many states are actually looking at tying up long-term coal-based power, because the intermittency of renewables is something which everyone is trying to get over, and which is why everyone wants to actually shore up their bucket by tying up long-term baseline baseline load capability also, which is why all this new coal-based capacity which is coming. And from that perspective, I see that like NTPC has already recently ordered about close to 6 gigawatts. And I believe a couple of other companies are also looking at ordering a few more capacities. So the overall demand supply requirement and the gap will be met, one definitely through coal in the near future, and also on a longer term basis through renewables and round the clock power storage solutions, and all these things will happen. So that's how it will keep on happening.
Okay. Now, I want to touch base with all of you on where do you see policy tweaks or longer term policy changes. But Mr. Bhargava, you are a neutral party. There's one man who is rating debt and another man who is assessing equity. You tell me which part of the entire ecosystem looks promising to you.
You're putting me on the spot because both these guys track the sector from specific areas and perspective. But you see, power sector is, if I may say, power sector is one where growth is happening and accelerated growth is happening. So whether it's the renewable sector, whether it's the thermal sector, I would also add, for example, nuclear on a longer term basis. So that will grow. And definitely the Gencos, the equipment suppliers, these are the people. And at some point I see that storage companies, for example, battery storage, or people who are also doing pump storage solutions, although that's a longer term solution that happens over a 4-5 year period. So these are the companies which will keep on doing well. Equipment space, definitely, because I don't have all the details, but for example, the 50 gigawatt bids happening on the renewable side. So there's a huge, and anyway, we see, we listen to you and other panelists also, the way the renewables people are, hand over fist, their prices are going up. I really don't know where that's headed.
Okay. Thanks for pointing out so many sectors which are still investable. Gentlemen, I have to take a quick break. Bazaar viewers, you will get to see Chartbusters. I will continue my conversation with my experts and you will get to see the whole show after market hours.
IT stocks, TCS, Wipro, HCL Tech, Infosys all gain on the back of Accenture's third quarter results. Constant currency revenue growth climbs 1.5%. The company says they continue to see strong demand for digital manufacturing and engineering services.
Aster DM climbs after 9.3% equity changes hands in a block deal window. Sources tell CNBC-TV18 that Olympus Capital Asia investment is the likely seller.
CEI Infosystems, or MapMind as we know it, continues to gain for the second day after brokerage firm Goldman Sachs initiated coverage on the stock with a buy rating, raised the target price to 2,800 rupees a share.
GM Financial falls over 4% after it was directed by SEBI to refrain from accepting new mandates as a lead manager in public issue of debt securities until further notice.
Fertilizer stocks like Chambal Fertilizer, RCF, GNFC see profit booking after the recent run-up. Chambal Fertilizers also comes out of the F&O ban. Recent run-up was on account of expectations of a GST rate rationalization. So maybe ahead of the event, some bit of profit taking.
Hello and welcome to Chartbusters here on CNBC-TV18. I'm Horbis Fatakia, with me is Mangalam Malu, and the final trading day of the week, that's the bigger takeaway, I guess, because the market remains in a range. The Nifty at 23,600 as we speak. The Nifty Bank, though, is seeing a bit of profit booking after the run-up that it has seen. Actually, the Nifty Bank is the star of the week, to be very honest. And after it's staying above those levels of 51,000 as well. So the Nifty remains in the range. 23,600 is where it is. What's doing well in today's session, of course, is IT. The top 5 gainers on the Nifty are IT names: Infosys, TCS, Wipro, Tech Mahindra, all of them doing well in today's trading session. What is also doing well is pharma, metals, and there are some underperformers as well, which is realty and FMCG. Mangalam, hi.
Hi, a lot of individual stocks actually are spiking as we speak. We have telecom stocks which are doing extremely well. Bharti Airtel has now moved towards the high point of today's trading session, and in fact, it's among the top Nifty gainers today, up around 3%. And also in the last few minutes, we've seen some pickup in the auto pack. So pick up something like Maruti, which is recovered from the lows, currently at the high point. We're also seeing some traction in Hero MotoCorp and Bajaj Auto. So both these stocks, in fact, what you do is if you just pull up the Nifty Auto Index, you would see that the Auto Index has picked up in trade and is at the high point. And also in the broader markets, a couple of themes doing extremely well. Railway continues to surge. We have RailTel, which is up around 11%. We're seeing RVNL up around 6.5%. Texmaco Rail about 6.5% higher as well. So that train, as you call it, continues to rally. But let's talk about some ideas for profit in a market like this, where we get you our colleagues from Money Control Pro to share those ideas. Sachin Pal is the one who's joining us today with a stock that he's been tracking.
Kajaria Ceramics, which is a leading tile manufacturer in the country, posted a modest revenue growth